Good morning and welcome to Bloomberg, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. Global equity markets drift as investors assess the unpredictable path of trade talks between China and the United States of America. Back home, Indigo shareholders approve all the resolutions, including amending the Articles of Association to increase the board seats in the company. SEBI Chairman Ajay Tyagi blames mutual funds for taking too much risk, says recent developments have exposed the fault lines. And Finance Minister Nirmala Sitharaman dismisses opposition's accusation of raiding the RBI's accounts, calls their remarks outlandish. And those barbs would continue for maybe the next couple of days as well. Let's take a look at the trade setup for the day, though. It looks like it could be a day that could meander along, simply because the world markets are mixed bag with flattish to marginally lower. US markets started off, or rather ended lower, about 1/3%. Nothing too dramatic, but 1/3%. A big development that happened, which will interest maybe the bond market, actually even the equity market watchers as well, is that all the yields, all the benchmark yields in the US are now sub the 2% mark. We've always seen this, that the 3-year yield may be down, but the 10-year yield isn't. I mean, a lot of to's and fro's. Now, if you look at the generic 2-year yield, 5-year yield, 10-year yield, all of the yields, all of the US yields are now below the 2% mark. That's an interesting development. It's the first time in history that this has happened. Now, does this in any way lead to the Fed's hands becoming stronger to cut more rates? Maybe, but if Jerome Powell is to be believed, data dependent still. So let's wait and watch what happens. Trump will of course call Jerome Powell the biggest enemy, and even that might continue. However, the US markets ended slightly lower, and I think the Asian screen and the SGX screen also indicating that the start may be mixed, maybe marginally in the green as well. The SGX actually indicating a start which could be 10-11 points up. But remember, we are reaching a bit of point of resistance. One is the expiry that is slated to happen in the next couple of days, and maybe there could be some expiry-related moves. So the markets, in all likelihood, will remain resilient. You will probably have this upside going, as we've been saying for the last 2-3 days, with the real estate package coming up and then one more package coming up later on. It's very unlikely that people will be able to create some very large fresh short positions. But we have the expiry coming up. There could be specific short covering moves in select names, but the markets at large might be a bit tempered. We also run in the next few days into the August monthly sales numbers, which in all probability will be weak. But the two key points to monitor, that a lot of this is known data. What is unknown is what will come up ahead. People will look forward to the festive season with Ganesh Chaturthi beginning on the 2nd. So maybe, just maybe, the sentiment might be a bit more positive. Flows, however, remain negative. FIs sold 923 crores. DIs, of course, put in about 1162 crores. But 2 days, MSCI rebalancing led outflows, have led the FIs to sell 923 crores in trade yesterday as well. Let's wait and watch if today's session is any different. However, it was the biggest single-day gain in 5 months for the rupee, which recovered quite smartly in trade yesterday, 71.48 for the close. And one more thing before we get to stocks is that amongst all the other things that we talk about the financial markets, we talk about mutual funds a lot, and we've spoken about how mutual funds have tried to enter into some agreements with promoters, etc., etc. I think SEBI has spoken about it. The SEBI chief has warned that our headline said that he spoke about the fault lines being exposed. I think the word that came out was that the MF industry should play by the rule book and stop compromising with investor safety. So some key strictures, if you will, passed by the SEBI chief in yesterday's session with regards to the mutual funds. However, what's to react in today's session at about 9 or 9:15? Will the market starting off in a very tempered fashion for the first time in the last 2 days or the last 3 days? Specific stocks have that much more importance. So Vedanta might be an important one. The Zambia's High Court has suspended the petition by state-owned ZCCM to liquidate the copper mine of Vedanta. The petition is suspended pending ruling by the Zambian Appeals Court, but net sentimental positive. Let's see if Vedanta reacts positively today. Fundraising plans by Yes Bank. They're going to consider the proposal on August 30th. I think the BQB exclusive is that the talks with at least 4 PE players have gone cold. So let's wait and watch what Yes Bank does. The last couple of days aided with short covering and a lot of other moves. Yes Bank too has done well. Let's see if this lasts. And I'll be particularly interested in the globally exposed auto names. Autos have some flavor to themselves. Yesterday, on the news of how China might defreeze the car purchases in select cities, Tata Motors and Motherson Sumi went up. I reckon they'll be in focus today as well. From what I gather, a lot of Chinese auto companies are surging in trade. Tata Motors has already had that in trade yesterday, but let's see, maybe the sentiment stays positive and it might do well in today's session as well. So I'll watch out for both of these stocks particularly as well. However, let's tell you what's lined up on First Word today. As I always say, it's the collection of the top editorial stories that we believe we should bring to you. The latest earnings season has prompted analysts to adjust their expectations from equities, and the number of downgrades are startling. Yash takes us through those details. The good monsoon has piqued investor interest in tractor companies, but would investors be better served to wait before they take the plunge? I'll explain perhaps why. Cement makers have been cutting prices for 3 months in a row now, but they may have found a silver lining beyond the clouds. Nikki tells us more about it. Well, let's start off with the disappointing performance by corporate India in the June quarter, which has led to many analysts to adjust their expectations from these stocks. Target prices for 2/3 of the stocks tracked by at least 10 analysts have been downgraded in the current quarter. Yash Upadhyay is standing by with a snapshot of the same. Yash, good morning.
Morning, Neeraj. So essentially what we've done is we've taken the all India listed stocks, which is more than 5,000 companies, and we've put the filter of at least 10 analysts covering them, which brings us down to the universe of 251 stocks. Now, of these 251 stocks, 168 companies, they have seen a downward revision in their target price, which is almost 67%, or 2 out of every 3 stocks, which has seen a cut in their full year target price estimates on Bloomberg. 81 have seen an upgrade in target price, and only 2 stocks remain unchanged as far as their target price estimate is concerned, starting from the end of first quarter, which is June 30th. In terms of individual stocks, in terms of individual sectors, 8 out of the 10 sectors have seen cuts in their target price estimates. Topping that list is the consumer discretionary space, industrials as well as technology. Consumer discretionary space overall saw a 10% cut in their target price estimates, followed by the other names. The 2 names which saw a modest increase in the target price were consumer staples and utilities, but only a marginal 0.6% increase in terms of target price estimates. When it comes down to the individual stocks, I'll start first with the ones that saw sharp downgrades. Yes Bank and Vodafone Idea, they saw almost their target price being cut to half from where it was at the end of the first quarter, followed by eClerk Services, Magma FinCorp and Endurance Technologies, which have a direct impact on account of the auto slowdown. Coming to the individual factors, for Yes Bank, Jefferies, which has the lowest target price of 50 rupees, they highlight that the negative stance on the company is on account of the deteriorating asset quality, as over half of the new NPLs stand out of their watch list, as well as an increase in the below investment grade book for the private lender. When it comes to Vodafone Idea, it has been the consistent pressure on their subscriber base, which has been falling significantly. The low ARPUs on account of down trading and value bundles taking precedent over the premium packages, worsening core operating performance, and the high debt of the group that are in fact all of the negatives when it comes to Vodafone Idea. For eClerk Services, the company reported extremely weak set of numbers, which were below the street expectations. Again, lack of scale when it comes to their on-site operations, and headwinds from automation as some of the key headwinds for the company, as highlighted by CLSA in their recent report. The other 2 names, I'll start first with Magma FinCorp. They get directly impacted by the auto slowdown. 67% of their loan book is from vehicle financing, and that has been significantly impacted because of that. The high cost of borrowing as well as weak management commentary with respect to demand revival have been some of the other reasons which has kept analysts pessimistic when it comes to Magma FinCorp. And lastly, when it comes to Endurance Tech, again, overall a weak set of numbers when it comes to street expectation. There was an announcement that the company was likely to foray into 2-wheeler and 4-wheeler tire manufacturing, after which we saw the stock actually end with a lower circuit of 20%, and then the management came out and went back on that proposed move. So that was another reason why we saw the analysts lowering down their expectations.
Of broader market stocks going through that, Yash, I presume, at least on the downgrade front, but it wasn't all that bad. There are some stocks which naturally so, but there are some stocks which have witnessed upgrades as well. Tell us about them.
Oh yeah, I'll start first with Just Dial, which had the highest upgrade. Just Dial as well as HDFC Life from the life insurance pack, so almost about a 16.5% sort of upgrade in their target price, followed by Trent, Gujarat Gas and SpiceJet, making up the list of the top 5 stocks. When it comes to Just Dial, although the numbers were largely in line with expectations, there was improvement when it comes to their operating metrics with respect to unique visitors visiting the website, as well as increase in paid listing, the robust mobile traffic, and the company's focus on growth when it comes to the tier 3 and tier 4 cities. That is something that has analysts bullish on the counter. HDFC Life, without a doubt, the top pick among the private life insurance space. It has a diverse product portfolio with lower ULIP contribution and industry-leading margins. Mind you, it was the only private insurer apart from SBI Life which reported a sharp increase in annual premium equivalent, or EPE, in the month of July, and a third consecutive month of EPE growth. It reported a 58% year-on-year increase in EPE for the month of July on a year-on-year basis, which is another positive. When it comes to Trent, again, it was strong growth in earnings, which was led by 12% growth in their same-store sales growth. The company going forward is focusing on aggressive store launches as the way for growth, and they have outlaid almost 350 to 400 crore rupees for FY20 in terms of new store additions between Westside and Zudio, which is double of what they did in FY19. When it comes to Gujarat Gas, it reported its highest ever quarterly profit in the 3 months ended June, and almost outperformed all of its peers in the city gas distribution space. Sustained growth momentum when it comes to the NGT order, cracking down on coal gasifiers, as well as low LNG spot prices. That is likely to aid volumes going forward as well. And lastly, when it comes to SpiceJet, it reported its highest ever operating profit in the first quarter of FY20. That apart, the favorable industry dynamics post the grounding of Jet Airways and lower crude oil prices, they are some of the key tailwinds for the company, is why most of the analysts, they are bullish on these stocks.
Well, pretty interesting. Some of these are usual suspects as well. You would expect SpiceJet probably to do this, or HDFC Life to do this, but couple of other interesting names. I mean, Just Dial to see this is pretty interesting, Yash.
That's right. And in fact, SpiceJet, there were a few reports also which came over the last month or two, initiating reports which have a very high target price as well.
Okay. Well, we'll watch out for these. Keep in mind, if you just look at the life insurance premium growth in the month of July, that has slowed down a bit. So let's wait and watch what the August numbers throw up. I think the August numbers come out on the 10th or the 11th of September, and something around that would be interesting to see if the July, August, September period is turning out to be slightly different than the others. But great analysis. Thanks for that, Yash. Watch out for some of these names which have gotten those upgrades. We can always understand that the earnings season was not that great, so downgrades would have come in. But with the companies which stand out in a difficult environment might be the ones which might attract investor attention. Well, speaking of investor attention, HDFC Life and HDFC AMC have certainly attracted that. Those stocks are just really rocking it on the charts. But the other pack that we want to talk about is autos. Now, we've spoken about them ad nauseum, even as most automakers face a sharp slowdown. The tractor industry has managed to remain relatively resilient. But if you're betting on them to get you out of the ditch, just hold on. And I have reasons why I'm saying so. So first, let's put into perspective what is working for the auto space, right? I mean, if you just look at some of the factors, they are probably existence for some time now. What works? Easy financing. Usually the tractor companies don't have a problem in finding financing. A branch manager who's tasked with distributing or disbursing 20 lakh rupees might find it very difficult to find maybe 40 farmers to buy 50,000 rupees worth of seeds. But to find 3 farmers to buy a tractor each on easy financing is easy. So that is one part. There is no shift to BS6 emission as is mandated for the other auto verticals, and therefore that the disruption for the tractors is not going to happen in the months of December and March, essentially, when April, when the shift does happen. Electric vehicles, we all know that the focus towards moving towards electric vehicles, but electric tractors, let's face it, are a while away. So even that is not quite having an impact, or not going to have an impact on tractors. So you would think that almost everything is working in favor. There's no disruption. Why not? Well, I'll tell you why not. There are 2 or 3 things that definitely work against the tractor industry. Firstly, fickle monsoons, and we've seen what's happened in the state of Karnataka and Kerala might having an impact on what will happen. It's, by the way, not just these two states. We all know what's happened to Himachal Pradesh, Bihar as well, and all of these are agrarian states which might have an impact on tractor demand in the month gone by, and arguably in the couple of months to come, because if farmer income is disrupted, he'll not have the gumption to go out and buy tractors. So the fickle monsoons are the biggest drawback for this year at least. The high base effect, and you might ask why a higher base, because frankly, if you look at the numbers in annual tractor sales in lakh units, India, for almost similar arable land as China, sells at least 1.5 times the tractors of China, sells 3x the tractors sold in Western Europe, and almost 2.5 times the tractors sold in the United States of America. So the base effect for India is very, very high. And frankly, the slowing economy. I mean, today's Bloomberg Quint website first up speaks about a gauge which shows that Indian economic activity has slipped further in the month of July. So in such economic scenario, you don't see people going out and, especially farmers going out and buying tractors or cars left, right, center. So that will also not work for the tractor companies. And, the other key thing is that if we take history into account, the past tractor down cycles have lasted a lot longer than what you could think. Now, I've got a statistic out here which viewers might be interested in. If you just look at the 4 previous down cycles that we've seen for the tractor industry, that's on your screen. The periods are FY 1999 to FY03, FY08 to FY09, which was lasted for about 2 years. The one that happened in FY13, and the one that last one happened in FY15-16. Now, look at the moves. They vary from 5% to 35% to 22%, with an CAGR number ranging from 1% to 2% to 8% to 12%. So, and forget the CAGR, the absolute number is more important, right? Because you do not know how long this will last, which shows that the down cycle could last for as high as 2 years, as high as 5 years to 2 years, and the numbers could be so varied. Now remember, the tractor down cycle that we are underway currently has lasted what, about 2 quarters or 2.5 quarters at best. There's still some way if the time periods are taken into account. The shortest cycle lasted a year, the longer cycle lasted 5 years. So you do not know how soon will we come out of this down cycle, and that is something that should keep people on their toes. This is, of course, the numbers that we've gotten from the Jefferies report as well. The other factors at play, there is a high inventory buildup. We've heard enough and more dealers as well as tractor companies speak about it. The demand is uncertain because of a number of factors that I said. And we read a report about how government is mulling an Uber for tractors kind of a policy. We all know what Uber and Ola have done to the car market. There might be an initial spurt, but overall there is a weakening of demand because car ownership has become a problem. Who knows? And Uber for tractors, if it's successful, might do that to tractor ownership as well. Difficult to see whether that will happen for sure or no, but something that you should keep at the back of your mind. The other part is, if indeed there is no certainty about when the tractor cycle will end, should you buy into these valuations? Because a lot of people say that the stocks have corrected, maybe good time to buy. Hey, look at the valuations. So two names that I've picked up, which is Mahindra & Mahindra and Escorts. This is the Bloomberg estimate price to earnings multiple that has come in. And as you can see, while M&M is off, the yellow line is the average price to earning multiple. As you can see, M&M is way lower than the average. And it is around the levels from which it has traditionally bounced back. So you could still argue that maybe the valuations are in favor for Mahindra & Mahindra, at least in terms of the levels from which it has traditionally bounced back, though time may be a factor here. But Escorts, it's right at the line where the average multiples are, and it's still substantially higher than the lows from which it typically tends to bounce back. And therefore, you got to ask yourself if indeed you are completely convinced that the tractor cycle is moving up, and if so, then there might be merit. Otherwise, you might be just betting on it a bit too early. Analysts, are they betting on it a bit too early? Difficult to say. Sell side average expectations are different. So for a Mahindra & Mahindra, the LTM is about 42%. The return potential is just about 19%. Flip over to Escorts, and you will see that despite that sharp crack, the return potential is only about 20 or 21 odd percent. The question that you got to ask yourself is that if indeed the cycles are so long and the recovery is uncertain, would you want to bet your horses on a space which might give you 19-20% returns? And if the answer is yes, sure, go for it. Otherwise, maybe look around. Don't bet on tractors necessarily to get you out of the auto ditch. Well, That's about tractors. What about cement? That's the third one of the numbers which we'll hear about in a few days from now. But the prices have tapered during the monsoons generally, and this time around it's no different either. A Bloomberg Quinn survey done amongst 15 dealers show that the steepest drop has been in South India. But cement makers don't seem to be so worried right now. Nikki Mirchandan is here to tell us why. Nikki, first take us to the average prices.
Sure, Neeraj. Actually, there is a good news in offering for cement makers, although it's a lull period this time around, and also we're staring at a festive season. But then cement prices, let's look at the South India prices, because that's the region which has been witnessing steepest cut around. It's the 5th consecutive month of cut for South India. It's a 30 rupee per bag cut. We've seen floods in Kerala, and we've seen government stalled projects, which in turn is weighing on the construction activity of the region as a whole. If you look at the 5 months that the region as a whole has lost in terms of the cement pricing power, it's a 80 rupee cut as compared to a 75 rupee gain that we saw in the month from Feb onwards to March. That's the 2 months when the region as a whole saw some amount of great traction. Next in the list, we have East India. That region itself also saw some cut coming in, 10 rupee per bag. It's the 3rd consecutive month of cut coming in for this region. We have seen a labor shortage as well as water shortage, which is weighing on the construction demand on this region as a whole. Western region, there also the trend is no different, just that the quantum of cut is a little lower as compared to that of East India. It's a 8 rupee per bag cut, and also 3rd consecutive month for West India. Also, if you look at Northern India, well, there is no one region that I could pick up for you and tell that this is a region which has shown some amount of price hike or stability. There also there's a cut, 10 rupee per bag for this region coming in, and dealers are not too bullish even for the next month going ahead. Look at the other region that we have, that's Central India. This is one region which relatively has shown some amount of resilience in the face of lull demand, on account of one thing, which is absence of capacity additions which are taking place or are not taking place in the region, because other region relatively they're seeing some amount of great capacity addition, which is to an extent expected to outdo the demand situation. But then here it's a 6 rupee bag per cut after a stability that we've seen in July. Overall, if you look at the all India trend, average prices there this time around, it's the 3rd consecutive month of cut on pan India basis as well. Average sums up to around 12 rupees per bag. But then things are a little better going ahead for these players, Neeraj.
That's why cement makers are not too worried, Nikki, because they don't seem to be too worried a lot.
Yeah, because if you look at the potential price hike, we've spoken with the dealer survey, we've done it in South and West, where the dealers suggested that they're looking at a potential price hike for the month of September. If you could bring on to the chart, would suggest that we're looking at a price hike coming in for the region. Look at North. I think North is the only region where we are seeing some amount of different trend. They are actually looking at a cut of 15 to 20 rupee per bag. But look at South India. After 80 rupee cut that we've seen in the last 5 months, they're actually looking at a hike. Dealers, both from Ultratech and Ambuja Cement, they've been sounded off of a potential price hike coming in with effect September 1st. West India, the trend also is no different. Mumbai, Gujarat, all of the dealers that I spoke to, they suggested a potential price hike to the tune of 5 to 10 rupees per bag. Central India, we're expecting trend to remain stable, given the kind of trend that the region as a whole has shown in the past 1 year in absence of capacity addition. Net, not an ugly picture coming in from the cement makers. In fact, I'd go on to point the fact that the construction activity actually only picks up in October, and that's when we see the price hike. But this time around, all the dealers are trying to all the companies are trying to implement a price hike. Whether or not that's sustainable remains to be a question, but nevertheless, there is an attempt, or they've already sounded off the dealers for a potential price hike coming in the next month.
Well, let's wait and watch if that happens and what's the magnitude of that. Nikki, thanks so much for bringing us this survey. And of course, you can log on to our website and try and get a snapshot of almost all of these stories that we present to you on First Word. That's all that we have today on this leg of First Word, but lots more lined up on Indian Open. We talk, of course, markets and macros with Harsha Upadhyay of Kotak Mahindra Asset Management Company. We're talking about cement. We'll discuss the demand and pricing scenario for cement makers with H.M. Bangur of Shree Cement and Sanjay Ladiwala of the Cement Stockists and Dealers Association of Mumbai and see if there are any signs of recovery for the real estate sector. A lot of assumptions about what will come out from the government. We'll talk to Gulam Zia of Knight Frank India about the same. But after this break, a full tilt towards the day's trade.